Well, good afternoon, folks. It is exactly 12 noon, and we are going to get started. We are broadcasting live from our individual homes, and we want to just say thanks for tuning in. It is April 6, 2020. We are now, as a firm, entering into our fourth week of working remotely. And we are updating the webcast that we did last Wednesday. Since that time, there's been a few changes that we want to bring to your attention. And we are going to start. It's a beautiful, by the way, afternoon. Sun is shining. You may hear some birds chirping in the background. Hopefully, the garbage men won't pick up the garbage exactly when we do this presentation, or there won't be any fire alarms. But the information that we have to share with you is important. And there you'll see a slide that basically is our caveat that you should consider the things that we are saying and consult with your professional advisor, because we are presenting this for informational purposes, but candidly, things are changing every day. In fact, you'll hear in our discussion today how there's still some questions that are out there that no one has been able to completely answer. In fact, I'm sure that many of you have either applied or are applying to your banks. And if you go to more than one bank, they seem to be asking different questions. So hopefully we'll help through that, although just know that we're still getting information even as we speak. See before you our agenda today. So we're starting with an introduction. And we are focused primarily on the two CARES Act loan incentive programs, the Paycheck Protection Program and the Economic Injury Disaster Loan. We're going to talk through those. We're going to also come back with some key takeaways and considerations, and from there we'll do some Q&A. Before you see some pictures of the folks on this webinar, first is myself, Todd Polinack, partner at Sachs and part of this Sachs Cares task force, as well as others, including my two partners on the line, Josh Shinani and Stephen Ehrenberg. Guys, say hello.
Hey, good morning.
Perfect. That's what I like to hear. So we are going to get started, and we're going to get started with the first incentive program, fondly called the PPP program, or P cubed, the Paycheck Protection Program. Say that 5 times fast. Josh, take it away.
So the PPP cubed, however you refer to it, or what I like to refer to it as free money. Good morning, everybody. So we're gonna talk through the first part of the PPP program. It is defined in Section 1102 of the CARES Act. It does authorize borrowers to work directly with their banking institutions in order to secure the funds. So as we said Wednesday, we'll say it again right now. If you have not been in touch with your bank, specifically your loan officer, it's very important that you get in touch with them. A lot of banks are trying to do this electronically, but as Todd said, there is still a lot of questions out there, so they are important people to know during this time. The Act does provide for $349 billion in aid aimed at small businesses. There is the possibility that more money is coming, although not definitive at this point. There was some additional guidance on the program that was issued on Thursday, April 2nd, in the form of a 31-page explanation called the Interim Final Rule. So if there are additional questions that go beyond this webinar, that would be a good place to start. A portion of these loans are eligible for forgiveness. The funds must be used for specifically designated costs that we're going to touch on later. And also, too, the forgiven funds do avoid the federal cancellation of indebtedness income recognition. There is still some question as to whether or not the states will follow. We do expect that to happen, although they have not put out a final rule on that. The businesses that are eligible for the program include for-profit and certain not-for-profit entities. Eligibility is based on employees. There are certain exceptions for the accommodation and food service industries. There are certain rules for affiliated groups. There still is further guidance pending. The purpose of this is that it is aimed at identifying groups under common control with employees over 500 in total. So as you start to fill out the forms, there are questions about related entities. So again, that is something that the SBA is focused on. In addition, there are certain SBA designated industries which will allow you still to apply as a small business, even if you have over 500 employees. In which case, if that is your situation, you want to go to the SBA website. You want to have your NAICS code available, and that will help you determine whether or not your business could be eligible for these funds if in fact you do have an excess of the 500 employees. The program is also eligible for sole proprietorships, independent contractors, those self-employed individuals. It is important to note that you can only have one loan per borrower, and the ability to repay the loan is not an eligibility requirement. So in terms of who is not able to apply for the loan, any borrower or any business owned or controlled by the borrower or any of its owners cannot have obtained a direct or guaranteed loan from the SBA or any other federal agency that currently has a delinquent loan or has defaulted on a loan within the last 7 years and caused a governmental loss. The SBA, as I mentioned before, has indicated that further guidance is coming on the affiliation rules. So what kind of documentation do you need to have available as you start to apply for these loans? Well, certainly the first question the SBA is going to ask is was the borrower in business on February 15, 2020 or earlier? And like I said, the documentation which you'll have to provide includes copies of your 941s, your payroll taxes. The banks are asking for you to provide them with copies of the 1099 MIS that were filed for year-end 2019. And in terms, if you were a sole proprietor, independent contractor, the banks are asking you to provide payroll tax filings if you have it, forms 1099 misfiled for independent contractors, in addition to your current P&L for the business. In addition, as part of the application process, the borrower must make a good faith certification to these 4 points. The first is that the uncertainty of the current economic condition makes necessary the loan request to support the ongoing operations. You must acknowledge that the funds will be used to retain workers and maintain payroll or make mortgage payments, lease payments, and utility payments, and will We'll dive into that a little bit later. There is not an application pending for a Paycheck Protection Program loan for the same purpose and duplicative of amounts applied for or received under a covered loan. During the period from February 15, 2020 to December 31st, 2020, the borrower has not received amounts under this subsection for the same purposes and duplicative of amounts applied for or received under a covered loan. And the definition of a covered loan is a loan made under the Paycheck Protection Program from February 15, 2020 to June 30th, 2020. Borrowers, this is one of the changes highlighted in the interim final rule. Is the question we would get many times is, can I apply for both? And the answer is yes. Borrowers can apply for loans under the Paycheck Protection Program and the EIDL loan program. The EIDL must have been received from January 31st, 2020 to April 3rd, 2020. If the proceeds are used for payroll costs as defined later, the EIDL must be refinanced as part of the PPP program. And then there is also the option for a $10,000 advance on the EIDL, if applicable. It will be received as part of the EIDL and then deducted against the loan forgiveness. And again, we'll discuss that later. So how is the loan calculated? The maximum loan is the lesser of component one and two. So 2 times your average total monthly payroll costs during the 1-year period before the loan is made, plus the outstanding of refinance eligible loans, which is the EIDL loan that was made from January 31st, 2020 through the date of the Paycheck Protection Program. So the 2.5 times the average total monthly cost plus any eligible refinance of EIDL, or $10 million. And again, remember, it's the lesser of either 1 plus 2 or 3. If you're a seasonal employer, your period for which you look at payroll is a little bit different. That number is here. And if you're a newer business that has not been operating from February 15, 2019 to June 30th, 2019, you're going to replace item 1 from the prior slide with this new period. So it would be 2.5 times your average total monthly payroll costs from January 1st, 2020 to February 29th, 2020. And again, in both this scenario and the previous scenario, items number 2 and 3 apply. So including the refinance eligible loans and the lesser of the and the $10 million cap is also the same. So what's included in payroll costs? This is per the statute. So payroll costs for employees include salaries, wages, commissions, or similar compensation, payment of cash tips or equivalent, and then all your benefits, your payment of vacation, parental, family, medical, or sick leave, severance payments, group healthcare benefits, including insurance premiums, retirement benefits, and payments for state and local tax assessed on the compensation of employees. If you're an independent contractor or sole proprietor, your eligible costs are either wages, commissions, income, or net earnings from self-employment or similar compensation. Payroll costs exclude, per the statute, compensation of an excess of an annual salary of $100,000, FICA taxes, Railroad Retirement Tax Act taxes, or other taxes collected at the source on wages imposed or withheld between February 15, 2020 to June 30th, 2020. Compensation paid to employees with non-U.S. principal residence, or qualified sick leave and family leave wages for which a credit is allowed. So as Todd mentioned in the beginning of the presentation, there are some inconsistencies between banks, and I'm gonna speak to those for a minute. During this process, we've really done our best to speak to many different attorneys, other accounting firms, um, payroll companies, and bankers, really to try and push forward the best message, and best information that's been out there. Some of those inconsistencies are as follows. The first is that some banks are accepting applications that are $100,000 per individual all in, meaning that it includes compensation and benefits. There's some banks who are currently accepting applications that are $100,000 cap on just wages plus benefits. Um, another inconsistency is that some banks are requesting you to provide that payroll information for the 2019 calendar year, and some are asking you to provide the payroll cost information for the preceding 12 months, meaning April 1st, 2019 to March 31st, 2020. So it's important, once you have that application, to really read through the instructions. If the banks allow you to provide the information either on a calendar or the preceding 12 months, it benefits you to calculate the computation both ways and see what gives you the better result. And then finally, at the moment, there is no specific guidance about if and how active members of LLCs and active partners of partnerships that are allocated self-employment income should report their SE income for purposes of the maximum loan computation under the Payroll Protection Program, and whether they are entitled to receive a Payroll Protection Program loan. So again, it's very important to understand where you're applying, what their requirements are, and follow that. So now I'm going to flip it to Todd, who will discuss the use of the proceeds and how the loan would be eligible for forgiveness.
Okay, thank you, Josh. So the loan proceeds. So there is a requirement that the loan proceeds be used for the following: payroll costs, group health care benefits during the period of paid sick, medical, or family leave and insurance premiums, interest on any mortgage obligation. That doesn't include any prepayment of or payment of principal on a mortgage obligation. So it's not the principal, it's just the interest. You can use a loan proceeds for rent, for utilities, for interest on any other debt obligations that were incurred prior to February 15th, 2020, and or refinancing an SBA EIDL loan made from January 31st, 2020 through April 3rd, 2020. And the EIDL proceeds received during this period used for payroll costs must be refinanced with a PPP loan. We'll talk about that a little bit later. And if your EIDL was not used for payroll cost, your PPP eligibility is not impacted. Now the good news, this is what makes it free money, the loan forgiveness general rules. So in order for the loan to be forgiven, the loan proceeds that are used during an 8-week period from the origination date of the Paycheck Protection Program loan, that's used for 75% on payroll costs, with the remainder eligible to be used for interest payments on mortgage obligations on real or personal property incurred prior to February 15th, 2020, rent payments made under lease agreements entered into prior to February 15th, 2020, and utility payments related to the distribution of electricity, gas, water, transportation, telephone, or internet service for which service began prior to February 15th, 2020. Just to point out, you can't, if you notice in that slide before, you can't use the proceeds to pay interest on other obligations and have it eligible for forgiveness. Okay, the forgiveness amounts may be limited for some other things as well. Workforce reductions, which means the reduction in headcount, and individual employee compensation reductions in excess of 25%. Now, there are exemptions that exist for borrowers who rehire employees and or restore salaries, and we're told that the SBA is going to provide some more guidance on loan forgiveness, I guess, after everybody gets the loan. So let's talk about the first piece, workforce reduction. So think in terms of the change in the headcount of your employees. There's a calculation that needs to be done. It's this wonderful formula, A being the average number of full-time equivalent employees during the 8-week period beginning with the date of the origination of the loan, and B, the average number at the borrower's discretion of full-time equivalent employees from February 15th, 2019 through June 30th, 2019, or January 1st, 2020 through February 29th, 2020. And part two of that is the amount of costs that are eligible to be forgiven. So look at this beautiful formula. A divided by B times C. So think in terms that this is going to reduce what is eligible for forgiveness. The point is that if you have a drop in your full-time equivalent employees, then you will receive less of a relief from the loan forgiveness. Salary reduction. The loan amount eligible for forgiveness may also be reduced by decreases in salary wages of any employee if the decrease occurs during the 8-week period, beginning with the date of the origination of the loan, and the decrease is in excess of 25% of the total salary or wages of the employee during the most recent full quarter during which the employee was employed prior to the commencement of the 8-week period. And they do provide an exemption for those individuals whose annualized wages or salaries were in excess of $100,000. So there is a relief. So there is a way to mitigate this if you're laying off people or you're furloughing them. If during the period from February 15th, 2020 through April 26, 2020, there's a workforce or salary reduction that meets the criteria on the earlier slides, but you as the borrower restore the FTE employees to the pre-February 15th, 2020 amounts by June 30th, 2020, and or the borrower restores the reduced salaries or wages for employees to the pre-February 15th, 2020 date, then you will not be harmed. So think in terms now, you are going to get this loan, you're going to spend this loan, and then you want this loan to be forgiven. Well, you need to know, you need to provide certain documentation to the bank that's providing you the loan. Number of full-time equivalent employees on payroll and pay rates, payroll tax filings with the Internal Revenue Service, state income, payroll, and unemployment filings, canceled checks, payment receipts, transcripts of accounts or other documents verifying payments on covered mortgage obligations, covered lease obligations, and covered utility payments, and certification from an authorized representative that the document presented is true and correct, and the amount for which forgiveness is requested was used to retain employees or make interest payments or mortgage obligations rent obligations, and/or utility payments in force prior to February 15th, 2020. And the lenders have 60 days to tell you whether or not that loan will be forgiven. But oh no, what if the loan is not forgiven? Well, here is what will happen. The loan will be eligible for a 6-month deferral. It is going to be at a 1% interest rate. It's going to be for an amortization of 24 months or 2 years, but there's no borrower or lender fees. There's no collateral requirements. There's no personal guarantees. It's non-recourse provided the funds are not used for unauthorized purposes, and there's no prepayment penalty. So that's what we have to say at this point on the PPP loan. Take it away, Stephen, on the EIDL loan. I'm passing it off to you, my friend.
Thank you, Todd. Good afternoon, everybody. Hope everyone's hanging in there as best as possible and making do under these uncertain terms. As Todd mentioned, I'm going to be discussing the economic injury disaster loans, or EIDL as it has been abbreviated. So with that, the EIDL program has actually been around prior to the outbreak of COVID-19, excuse me, of COVID-19. However, due to this unfortunate circumstance that's going on throughout the country and throughout the world for that matter, the CARES Act, and namely Section 1110, has expanded eligibility and perhaps loosened some of the requirements. So from an entity perspective, for-profit and nonprofit businesses, as well as co-ops and ESOPs are eligible to participate in this program. Similar to the PPP program, eligibility is headcount based. However, the NAICS codes and affiliated rules that relax some of these requirements are not really available under here. So you'll see it's a little more stringent to apply if you're at or near the 500 employee threshold. Companies that are eligible, it takes kind of a spider web approach in that businesses directly and indirectly by the pandemic, as well as businesses that provide services and or products to these impacted businesses, are indeed eligible. So many institutions are going to be eligible for this loan program. However, the key component, which as Todd and Josh alluded to, the key component of the PPP program was that there was this free money concept. Well, other than a $10,000 advance, which we'll discuss later, there really is not a forgiveness component here, such that these will be administered typical to other loans as a traditional loan. Whereas the Paycheck Protection Program loan, that's going, as most of you have already seen, you're going to be applying through your bank. Ultimately, the bank will be coordinating with the SBA. The EIDL program, applicants go directly online or can file via paper, but go directly online to the SBA's website. And, you know, there was a lot of website traffic during the past few weeks, obviously. So applicants may have not been able to actually upload their data online. So they were being requested to mail in the information. One thing to keep in mind, though, this slide deck, you know, we try to update it as we go, but it is more static than some of the requirements. So there may be, or there is a streamlined application approach that's available on the SBA website, whereby you can apply and then provide some of the documentation that's needed at perhaps a later time. And what we were saying is that the requirements for the EIDL program are much more stringent in that you're going to be requested to provide financial data, tax return transcripts, some other data just to support why the bank essentially should be making or why the SBA should be making a loan to you. Whereas the eligibility requirements from the PPP program were just basically, were you in business and were you making payments? The requirement to repay will be a criteria. And whereas on the PPP program, there were no collateral requirements, under the EIDL program, for borrowers looking for loans in excess of $25,000, there will be a collateral requirement, but it's good to know that applicants will not necessarily be rejected due to lack of collateral. So what this means is that the SBA will look at other factors, and we'll get into that momentarily, but strictly not having collateral will not be a pro or con in terms of how you are looked at for the loan. And what we were mentioning before are there these $10,000 forgivable advances, grants, call them what you will, that are available under this program. And if you read the act or the law, it says you can apply, and your eligibility, whether or not you're approved for the EIDL won't impact your eligibility to receive this $10,000. However, as Todd was saying before, proceeds from the $10,000 advance on the EIDL, at least according to the interim guidance that we received, will be deducted from the loan forgiveness amount. So the SBA is going to be issuing more information as it pertains to the loan forgiveness. So we'll see how this is treated, because there is a little bit of inconsistency, but in any event, at least if you're going to follow the interim guidance, it looks like the $10,000 advance will be deducted from the loan forgiveness on the PPP. So as we were saying before, the application requirements, they're actually going to look at the financial strength of the borrower. And our understanding is that tangible net worth and average net taxable income thresholds will be looked at to see if the borrowers are indeed eligible. But again, the process is not that static. So if you're at or near these thresholds but still want to apply, I don't see any harm in applying. If they're going to reject you for this, fine, but let them make that decision if you are considering this program. And what we mean here by this last bullet in terms of consideration of affiliated groups and multi-entity ownership is in that look at who you're applying for. So if you're over that threshold but have certain entities in your group that don't need to apply, then you can pull those out or look to pull those out to see if you can get under these thresholds. They're essentially trying to make it so it's for certain small businesses not exceeding a certain value and taxable income threshold. The maximum loan amount under this program is $2 million, whereas under the PPP that we alluded to before, that maximum is actually 10. Here it's 2. And under the PPP, that loan balance was a formula-driven computation, basically based upon your payroll costs and other EIDL loans that were refinanced in, depending upon if you're seasonal or a new employer, but that's the general gist of it. This one is not formula driven. It's going to again be based on a number of different criteria that the SBA is going to be looking at, but it's basically based on size, financials data, financial strength, and other criteria really that the SBA considers as they look at your business. So these loans, whereas under the PPP, to the extent your balances are not forgiven, these loans have a longer amortization period, as you'll see. You get 30 years to pay them off at a fairly favorable rate, ranging between 2.75% for not-for-profit entities and 3.75% for for-profit entities. So you certainly have more time to make payments on these loans. Similar to the other loan program, there's no fees nor prepayment penalties, although personal guarantees for loans essentially in excess of $200,000 may be required. And as we hinted at too before, the ability to repay here is a criteria for receiving a loan. So again, this just goes into the fact that the SBA is going to be looking at a number of different criteria when determining your eligibility for these types of loans, because you are at some point going to need to pay them back. As far as the utilization of the proceeds from these loans, it's a little bit more expanded than under the PPP program, in that we see you can provide paid sick leave to employees unable to work due to being directly impacted by the virus, payroll due to substantial slowdowns or disruptions, supply chain costs that you may have not been able to meet, rent or mortgage payments, and repaying obligations that you otherwise weren't able to pay because you lost revenue, essentially lost the cash flow to repay these. So there are more abilities and more avenues for taxpayers to use this. So just something to keep in mind if you happen to be applying for both. And I think with that said, I'm going to turn it back over to my partner, Josh, and he's going to go through some key takeaways and considerations. And there are certainly a lot of things that are out there, but he's going to go over this before we take a Q&A. Take it away, Josh.
Thanks, Steve. So just some general takeaways with respect to the two programs. Just want to reemphasize again, because this is different than Monday. Applicants are eligible for loans under both programs. There are also interactions with other credits and incentives as you apply for these loans. It is important, again, to consult with your tax advisor. This is only a small piece of the CARES Act. As many of you, I'm sure, are aware or getting emails from payroll companies, various HR companies. There are other credits and incentives that go beyond what we're discussing today. So it's important to understand, if you apply for one, does it have an impact on the other? Just again, the Paycheck Protection Program loans, they are a $10 million maximum loan, subject to a formula, as we discussed. There is the potential for forgiveness of, if not all, of the debt. There are differences that exist between the use of funds and funds eligible for forgiveness. The application process is completed through SBA designated banks. Again, if you're not 100% sure at this point if your bank is participating, you really need to make other arrangements, as lots of applications are being submitted. And again, there is a 2-year amortization period for this loan, payable at 1%. And then to recap the EIDL, it has a $2 million maximum loan balance, again, at the SBA's discretion. Then there are certain net worth and taxable income limitations that Steve alluded to before. It is a much more detailed application process through the SBA for this program as compared to the PPP program. For those of you who have already submitted, you'll certainly know and agree to that statement. There is no forgiveness aspect to the EIDL loan, other than the potential $10,000 advance that Steve mentioned. And again, with respect to this loan, it is a 30-year amortization, payable at 2.75% for nonprofits and 3.75% for for-profits. And again, I'll just, in terms of takeaways, I will reemphasize, it is very important for you to consult your professional advisory team, your attorneys, your accountants, and your banks. And if your bank is not participating and you're unsure as to where to go, there will be an email address at the end of this presentation where you can submit that question, and we can certainly help you with that. So we have gathered from the folks who participated Wednesday, our partners, other people, we have gathered some of the frequently asked questions, and we're going to go through those now for your benefit.
Okay, thank you, Josh. I'll take the first one. Question: if my employee headcount exceeds 500, am I out of luck? Well, for purposes of these programs, you may be excluded, although we again, suggest you reference the NAICS code if you happen to be in the food and beverage or accommodation industry, as well as certain affiliated franchises. But if you are, not eligible for those exceptions, then there's another program for employees. We had issued a short e-blast earlier, or I guess late last week, for employers with 500 to 10,000 employees under the Economic Stabilization Fund, which is another fund, another incentive within the CARES Act. It's just a different section. So there's not a lot of information that's available for this one yet. So stay tuned, but hopefully there'll be some relief for you folks out there as well.
Thank you, Steve. I'll take the next question. In addition to the payroll cost component used to calculate the maximum loan amount under the Paycheck Protection Program, what is meant by outstanding refinance eligible loans? The answer to that is the loans that were received under the EIDL program from January 31st, 2020 through April 3rd, 2020.
Okay, question 3. The bill says payroll calculations are based on the last 12 months, but the instructions in some of the applications that banks have been providing say we will use the 2019 year figures. Which one is correct? So I think it speaks specifically to the application itself. If the application is requesting 2019 calendar year, then that's what you have to calculate it on. If it allows you to provide for either calculation, whether it be in calendar year or rolling 12, I think you have to calculate it both ways and see, again, what gives you the bigger benefit. But this is certainly one of the inconsistencies between the applications, as we mentioned before.
Okay, thank you, John. I'll take the next one. How are employees under a PEO treated for purposes of the 500 employee threshold? They are employees of the organization, not of the PEO. So this could help or hurt you in terms of your loan amount, but just know that PEO are your employees as opposed to the actual PEO of the organization. I'm sorry, they're your employees as opposed to actual employees of the PEO.
Okay, I'll take the next question. If I do not receive my loan until, say, June 1st, 2020, and if this program is not extended after June 30th, 2020, will my covered period only be 4 weeks instead of 8? The answer to that is, again, subject to SBA interpretation, but our understanding is that the 8-week period begins with the date that the loan is originated, and therefore you would not be impacted.
Okay. Can I use a PP loan to pay off my credit line? So under the PPP, it says that interest on certain debt obligations are allowable uses, but principal is not. This may be one area where we can expect to get some further clarification. The next question too, what types of nonprofits are included? The answer to that question is 501c3 organizations who meet the employee threshold, of course, and 501c19 veterans organizations are the two types of nonprofit organizations that are eligible for the PPP loan. Todd, you want to start and answer the last question?
Sure. Number 8, how do you think this will change the way people do business in the future? So I think our question is the how will this is pretty much what's taking place right now. I think that, this is my perspective. I believe that this is going to change the way businesses operate, first in terms of understanding that perhaps you can do more things remotely than you thought before. And if that's the case, that could impact the way that folks think about their offices and their employees and how they use technology. The second, I think, will be, I do believe, unfortunately, some businesses will realize that perhaps they really were overstaffed, that they probably don't need as many individuals as they had in the past. I'll hand it over to you next, Steve.
Thanks, Todd. Yeah, I think that's a great question, and just strictly from a social perspective, hopefully we can move past this. I know the quarantine aspect makes it difficult, and for me myself, I've certainly missed my colleagues a lot, and look forward to just the general ability to be in the same setting again. But I echo and agree with what you said. I think organizations will be taking a fresh look at how they operate, and perhaps this helps them identify certain holes in their operations and see if there are ways now that you kind of are forced into this where they can take a look and see if they can add some efficiencies. But again, hopefully this money also provides a stimulus back into the economy and allows people to keep their jobs and allows us to keep momentum moving forward as we hopefully get past the high point of the crisis. Josh?
Yeah, Steve, that's a good point. And I'll kind of finish with this with respect to that question. I'm really hoping that folks will rally, once we can all get back out of the house and, continue to support our businesses. I think it's really challenging times. I think people are deflated. Hopefully now that the weather's turning, we can kind of garner some positive energy back. But you're right, Todd. I think people will take a good hard look at their business, how they operate. Certainly before this all happened, there was a question as to could many businesses operate remotely. That seems to be, playing out on a daily basis, but we'll see. Only hoping for the best scenario here.
Thank you, Josh and Steve. Actually, just to close out this webinar, I would encourage everyone to really be focused on hope. I think that when a group of people lose hope, that's when things start to slide. So, I mean, my new saying is keep hope alive. Keep hope alive in yourself and your family and in your businesses, because I do believe that we will get through this if we all focus on the recovery and what we could do. And just this last slide, besides, if you have any additional questions, you see the email address that's being provided to you. And there is a webinar on April 8th at 10 a.m. that's going to focus on the tax provisions and incentives for businesses and individuals that we'll be giving. And visit our COVID-19 Resource Center that's found on our sacsllp.com site to register for more ongoing information and resources. So with that, just want to say goodbye, wish you guys the best. Remember, keep hope alive, and we'll see you next time. Editing out now from New Jersey. Take care.